Okay, picture this. You're not, manually glued to charts or placing orders, but trades are happening, positions managed, maybe profits rolling in automatically. I mean, the idea of automating financial trading, especially in crypto, where things move so fast, it's just really appealing.
It really is. It taps into that desire for efficiency, for taking emotion out of the equation, and just having systems that can work 24/7.
Absolutely. And that fascination, that's exactly what we're digging into today. We're going behind the scenes on building crypto trading bots, but we're not just covering the basics. We want to explore what it might actually take to build, let's call it, a super bot, especially thinking about it in the context of this really interesting decentralized AI network called Bittensor.
Yeah, we've pulled together quite a bit of material for this deep dive. Everything from like foundational guides on bot development to more advanced strategy discussions, and specifically this link with Bittensor.
Right. So our mission here is to sift through all this, pull out the really crucial nuggets. We want to get a solid handle on the core principles of building these things, look at all the different kinds of bots out there, and there are quite a few get real about profitability versus risk. And then, yeah, peek at where the cutting edge might be, particularly with Bittensor.
Think of this as your shortcut to understanding what's really involved in building and running these automated systems, and maybe seeing this new frontier in AI-driven trading emerge.
Okay, then, let's get into it. So starting right at the beginning, the nuts and bolts. Our sources are really clear. Building a trading bot isn't something you just, whip up casually. It's systematic. There's a definite life cycle, usually broken down into about 7 key stages. What's stage 1?
Well, it all kicks off with picking your programming language. That choice really sets the tone for everything else you'll build.
Okay. And after you've made that call?
Then you move into designing the architecture. This is like mapping out the bot's core structure, how information flows, where the decision-making logic sits, how it interacts with exchanges.
Right, the blueprint. And
Yeah.
then comes the brain, yeah. Creating the actual trading strategy.
Exactly. That's defining your market analysis rules, your entry and exit conditions, all of that.
Which you then have to actually code up in the programming stage.
Following that, and this is absolutely critical, is backtesting and validation. You have to rigorously test your strategy on historical data, then test it in simulated live conditions before you even think about using real money.
Makes sense. And once you're confident, or at least reasonably confident,
You deploy it, usually onto cloud infrastructure, maybe a dedicated server so it can run reliably, 24/7.
and the final piece, which sounds like it never really ends, is monitoring and optimization.
That's it. A bot is never done. Markets change, things break. It needs constant watching and tweaking.
It's interesting how much the sources stress that these steps are all linked. Like, you can't just be a great coder, but have a flawed strategy. A weak link early on just cascades down, doesn't it?
Absolutely. It's a dynamic system you're managing, not just a piece of software you launch and forget.
So you need the right tools for this job. Looking at programming languages, Python seems to be the big one, right? The dominant choice.
Yeah, it really is, for most people building crypto bots anyway.
And you can see why when you look at the ecosystem around it. It's relatively simple, readable, which helps with complex projects. But the libraries, that seems key.
Oh, completely. Libraries like Pandas and NumPy are just fundamental for handling all the market data, the time series stuff you get from exchanges.
And then for technical analysis, you've got things like TAlib, Tulip, Pandas. I saw Pandas does something like over 120 indicators built right in. That's a massive shortcut.
Huge. And for actually talking to the exchanges, libraries like CCXT are invaluable. It standardizes the APIs for, over 120 different exchanges, makes it way easier to trade across multiple platforms. Plus, you have specific ones like Python Binance, too.
And then there's the AML side. If you want to build a smarter bot, Python is kind of the default with TensorFlow, PyTorch, scikit-learn.
It's the standard. Now, while Python is versatile, other languages do pop up. Java, C++ often get mentioned for high-frequency trading, where raw speed is absolutely everything.
Uh-huh.
JavaScript might come into play for web interfaces, and you see newer ones like Rust and Go mentioned for performance and safety in certain specific scenarios.
So language chosen, now architecture. What are the absolute must-have building blocks inside a typical bot?
Okay, at its heart, you need a few key modules. First, data acquisition. That's how it gets market data, usually through APIs.
Then the strategy engine or signal generation module, that's the logic deciding when and what to trade based on that data.
Yep, an order execution module to actually send the buy-or-sell orders to the exchange.
And you mentioned this earlier, the risk management module. Seems critical, often maybe missed by beginners.
Hugely critical. Stop losses, position sizing rules that all lives there, essential safeguards.
You also need somewhere to store data, right?
Yeah.
Logs, performance tracking.
Data storage, definitely.
Mhm.
And ideally, some kind of user interface, even if it's basic, just so you can see what the bot's up to.
The sources seemed really keen on modular design. Why is building it in separate pieces so beneficial?
Well, markets change constantly, right? And
Mhm.
your understanding evolves. So if you want to swap out your trading strategy for a new one, or maybe change how you get data or connect to a different exchange,
Yeah.
if it's modular, you can hopefully just replace that specific component without rewriting the entire thing. Makes it much easier to update and maintain over time.
And thinking about our superbot idea, especially one potentially interacting with something like Bittensor, that architecture would need extra pieces, wouldn't it?
Oh, absolutely. You'd likely need specialized modules, maybe one just for talking to the Bittensor network, querying it for signals perhaps, another for handling different crypto wallets securely, probably more sophisticated signal processing if you're taking in complex AI outputs.
So connecting to exchanges relies on APIs. Can you walk us through how that works?
Sure, APIs are like the messengers.
Yeah.
Your bot sends a request, hey, what's the Bitcoin price?
Uh-huh.
Or place a limit buy order at this price, and the exchange sends back the data or confirms the action. You set this up by generating API keys on the exchange platform, usually a public key and a secret key.
And getting the permissions right for those keys, that seems like a big deal in the sources.
It's non-negotiable. You have to configure the key to have only the permissions it absolutely needs to function. For a trading bot, that typically means reading market data, checking account balances, and placing or canceling orders.
Right.
You almost certainly do not want withdrawal permissions enabled on the key your bot is using day to day. That's a huge security risk.
Makes total sense. So set permissions, securely store the secret key, activate it. And there are different types of APIs bots use.
Yeah, primarily two. REST APIs are the common request response type. Good for things like getting your balance or placing a one-off order. You ask, you get an answer.
But for live streaming data,
That's where WebSocket APIs come in. They're much more efficient for real-time stuff like live price ticks or order book updates. You open a connection, and the exchange pushes data to your bot as it happens. Less back and forth, less polling needed.
okay, API keys. Security has to be paramount here. If someone gets your keys,
Game over. They can potentially drain your account. It's probably the single biggest security vulnerability for bot users.
so best practices.
Definitely enable two-factor authentication, 2FA, on your main exchange account. Grant minimum necessary permissions to the API key itself. Use IP whitelisting if the exchange offers it. That locks the key so it only works from your bot's server IP address.
Good tip.
Never, ever share your secret key or hard-code it into your public code repositories. Use secure storage, like encrypted vaults or environment variables. Treat it like the keys to your house, or maybe even more carefully.
And exchanges limit how often you can hit their APIs, right? Rate limiting.
Yep. Make too many requests too quickly and they'll temporarily block you, usually with an HTTP 429 error code.
Oh.
Your bot needs to anticipate this and handle it.
Yeah.
Good error handling logic is key. Using something called exponential backoff, waiting progressively longer before retrying after a rate limit error, is standard practice. Queuing requests can help smooth things out. And prioritizing WebSockets for data streams often helps because they usually have different, sometimes more generous limits compared to constant REST polling.
Okay, so you've built your bot, you've got your API keys secured. You don't just turn it on with the real money, do you? Validation seems huge.
Absolutely not. Validation is crucial. The two main stages are backtesting and paper trading.
Backtesting is running it against old data.
Exactly. You simulate how your strategy would have performed using historical market data. This is your first sanity check. Does the logic even work? Does it show any potential? Helps find obvious bugs too.
There are tools for that, right? Like backtesting.py, Hummingbot.
Yeah, several good frameworks and libraries exist to help structure backtests. Jesse is another one mentioned.
But backtesting isn't the whole story. That's where paper trading comes in.
Right. Paper trading is running your bot in a simulated environment, but using live market data feeds, just with fake money.
Ah, okay.
Platforms like the Binance testnet are great for this. It lets you see how your bot behaves with real-time data, real latency, real exchange quirks, but without risking your capital.
Now, the sources all seem to include this big, flashing warning sign. Past performance is not indicative of future results.
And you really have to take that to heart. Just because a bot did well on a backtest or even paper trading doesn't guarantee future profits. A huge risk is over-optimization or curve fitting. meaning you tweaked your strategy parameters so perfectly that it fits the historical data too well, but it's brittle. As soon as market conditions change slightly, it falls apart because it wasn't robust.
And backtests might miss real-world costs.
Exactly. Things like trading fees, slippage the difference between the price you expected and the price you actually got filled at network latency, sudden news events. These can all impact real performance in ways a simple backtest might ignore.
So what does a good validation process look like?
It's multi-stage. You start with initial backtesting. Then you refine it, adding realistic costs like fees and estimated slippage, testing it across different historical periods, up markets, down markets, sideways markets. Then you do extensive paper trading to see how it handles live conditions. And only then, maybe you start live trading with a very small amount of capital, like a final test drive, before committing more significant funds. And the quality of your historical data for backtesting matters a lot too.
Okay, validated. Now, where does this bot actually run?
You generally have two main options: cloud platforms or a local server. Cloud providers like AWS, Google Cloud, Azure are popular. They offer high uptime, scalability.
And you can often choose server locations close to the exchange's servers to minimize latency, which matters for faster strategies.
Right. The alternative is running it on your own local server, maybe at home or in an office. You have more direct control, physical security.
Yeah.
But then you're responsible for maintaining power, internet connectivity, hardware, everything, 24/7.
Which brings us to another point the sources hammered home. This isn't set it and forget it.
Absolutely not. Ongoing monitoring and optimization are essential just to stay in the game.
What does that involve?
You need to constantly track its performance key metrics like profitability, maximum drawdown, which is how much your capital dips from its peak,
Yeah.
win-loss ratio, P&L.
And also checking if it's even running properly.
Yeah, operational health monitoring. Is the server okay?
Mhm.
Are the API connections working? Is it hitting rate limits? Is the exchange having issues?
And the strategy itself might need tuning.
For sure, markets evolve. Strategies that worked brilliantly last year might stop working this year. You need to be prepared to adapt your strategy, tweak parameters, or even switch strategies entirely. Plus, just regular software maintenance, fixing bugs, updating libraries for security patches, handling changes in exchange APIs. It's a continuous cycle.
Okay, we've got the foundation, how you build one. Now let's talk about the types of bots. It seems like there's a huge variety out there. They're not all trying to do the same thing.
Not at all. It's a whole zoo. There's specialized tools for specific strategies and market conditions.
Let's start with one that sounds simple but maybe isn't, arbitrage bots. What's the basic idea?
The core principle is to exploit tiny price differences for the same asset across different places. Like if Bitcoin is $50,000 on exchange A and $50,010 on exchange B, the bot tries to instantly buy on A and sell on B to capture that $10 difference.
And it's not just across exchanges, there are other kinds.
Right. You have simple cross-exchange arbitrage. Triangular arbitrage involves 3 pairs on the same exchange to find an imbalance. Spatial arbitrage looks across geographic regions. DX arbitrage focuses on decentralized exchanges. Statistical arbitrage uses more complex models to find temporary myth pricings. Even things like funding rate arbitrage on futures platforms like Hyperliquid.
The sources seem unanimous. For arbitrage, speed is everything. These opportunities vanish in milliseconds.
Absolutely critical, which means you're competing against very sophisticated players, often high-frequency trading HFT firms with dedicated infrastructure co-located right next to the exchange servers. Trying to beat them at their own game on major pairs is tough for an individual.
So maybe a super arbitrage bot today isn't about being the absolute fastest on the main routes, but maybe finding less crowded niches or using smarter analysis, maybe AI, to predict where these tiny differences might appear next.
That's likely where the edge lies now. Yeah, finding those less obvious opportunities or predicting inefficiencies.
Okay, shifting gears. Market-making bots, what's their job?
Their goal is to profit from the bid-ask spread. That's the small difference between the highest price someone is willing to buy at the bid and the lowest price someone is willing to sell at the ask.
How do they do that?
They place both buy orders, bids, just below the current market price, and sell orders, just above it, simultaneously. They're essentially providing liquidity, making it easier for others to trade instantly. When someone takes their bid or their ask, the bot captures that spread.
They need parameters set, like which market, how tight the spread, how many orders. Frameworks like Hummingbot help with this.
Yes, Hummingbot is a well-known open-source framework often used for market-making strategies. You configure things like the minimum spread you want to capture, how many layers of orders to place deep into the order book, etc.
What's the main risk here? It sounds fairly low risk if you're just capturing spreads.
The biggest challenge is inventory risk. Imagine you're making a market in ethist. You place buy and sell orders. If the price of ETH suddenly crashes, lots of your buy orders might get filled. Now you're holding a bunch of ETH that's rapidly losing value.
Ah, okay. You're stuck holding the bag.
Exactly. There's also adverse selection, the risks you're unknowingly trading against someone who knows something you don't,
Hmm.
and risks like the spread suddenly shrinking or extreme volatility making it hard to manage your orders.
So a super market maker might use more advanced techniques. AI for predicting order flow, maybe? Dynamic adjustments.
Precisely. Dynamically adjusting the spread width based on volatility or using sophisticated models to manage inventory risk in real time. That's where the super comes in.
Okay, then we have trend following and momentum bots. These feel like the classic trading bot idea for many people. Identify a trend, jump on board.
Yeah, that's the basic idea. They rely heavily on technical indicators to try and spot when a market is starting to move decisively in one direction, up and down, and then ride that move.
Indicators like moving averages, MCD, RSI, Bollinger Bands, those common charting tools.
Exactly.
Yeah.
Moving averages smooth price data to see the underlying trend. Massey looks at the relationship between two moving averages. RSI helps gauge if something is overbought or oversold. Bollinger Bands show volatility. Supertrend, parabolic SAR. There are tons of them used to generate buy or sell signals.
What's the catch? If it's trending, you make money. Sounds great.
The big problem is when the market isn't trending strongly. In sideways, choppy markets, these bots can get killed. They get lots of false signals, buy, sell, racking up small losses each time. It's often called getting whipsawed.
Right. And other risks. Overfitting the indicators to past data. Sudden reversals.
All major risks. Overfitting is a big one, tuning your indicators so they work perfectly on historical data, but fail live. Trends can reverse sharply, catching the bot on the wrong side, and most indicators lag behind the price action to some degree.
So a more advanced or super trend follower might need better filtering, using machine learning to qualify signals, combining multiple indicators.
That's the direction. Maybe using models that try to detect the market regime. Is it trending or ranging right now? And adjusting the strategy accordingly, using multiple indicators for confirmation before taking a trade.
And stop losses are absolutely essential here, I assume.
Non-negotiable. You need predefined exit points to cut losses quickly when a trade goes against you or the trend breaks down.
Wow, okay. And the sources mentioned a whole bunch of other types too, just to show the range.
Yeah, like scalping bots, aiming for tiny profits on huge volume, needing super high speed, and very low fees. Mean reversion bots, which do the opposite of trend following, they bet that prices will snap back to an average after an extreme move, working better in ranging markets.
Then the whole category of ML-driven bots. These sound like the really advanced ones, analyzing tons of data, maybe news or social media sentiment, adapting automatically.
That's the idea. They represent the potential for more sophisticated adaptive strategies, like Intellectia.ai is mentioned as an example.
Grid bots, too, placing orders at regular intervals above and below the price. Good for sideways markets.
Generally, yes. They try to profit from volatility within a range. DCA bots, dollar cost averaging, simply automate buying a fixed amount periodically or on price dips, more for long-term investing.
Sniper bots. Sound aggressive.
They are designed for pure speed to get into new token launches or initial coin offerings, ICOs, the instant they list. Extremely competitive, extremely risky.
Copy trading bots just mimicking other traders.
Yep. Platforms like Mizar facilitate that. You're essentially outsourcing the strategy.
And those Telegram bots have become popular, haven't they? Maestro, Unibot, BONK-bot for interacting quickly, especially on DXs.
Very popular for mobile use and quick sniping on decentralized exchanges. But the sources do flag significant security concerns, as you're often entrusting your private keys or trading permissions to a third-party bot interface. High convenience, but potentially high risk.
And finally, bots trying to trade based on news or sentiment analysis.
Right, analyzing text data from news feeds, Twitter, etc., to gauge market mood and trade ahead of potential shifts.
So the big picture here is there's no magic bullet bot. The best one depends entirely on the situation.
Exactly. Market conditions, the specific crypto asset, your personal goals, how much risk you can stomach. It all plays a role.
And you definitely see this trend towards more complexity with AML, but also easier access through things like Telegram bots, even if they come with caveats. The risk, reward, and complexity profiles really vary across the board.
Which leads us nicely into the next big topic, the profit puzzle. The allure of automated riches versus the uh, often harsh reality. Profitability isn't guaranteed. It's actually really hard to achieve consistently.
Yeah, the sources really emphasize this. What are the key factors that determine if a bot might actually be successful?
Well, first and foremost is the strategy itself. Is it fundamentally sound? Does it have a statistical edge? A brilliant bot running a flawed strategy just loses money efficiently.
Market conditions play a massive role too, right? Volatility, liquidity, whether it's trending.
Huge. A trend bot needs trends. A range bot needs ranges. Liquidity affects whether you can get your orders filled at the prices you want without moving the market too much. Slippage.
Execution speed, especially for faster strategies like arbitrage or scalping.
Critical. Transaction costs, trading fees, potentially network gas fees on DXs, these chip away at every single trade's profit. High-frequency strategies are especially sensitive to costs.
Risk management. We keep coming back to this, but it seems non-negotiable.
Absolutely fundamental. How much capital you start with also matters. Some strategies require significant capital to be viable, especially arbitrage trying to capture tiny spreads. And finally, competition. You're not trading in a vacuum. Other bots, human traders, big institutions, they're all out there.
So managing expectations is key. Building a bot that prints money consistently is, well, mostly a fantasy. It takes serious work.
It really does. It demands a mix of market knowledge, technical skill, maybe data science or AI expertise, constant adaptation, a lot of diligence, ongoing learning, and real discipline. These are tools, not magic money machines.
Let's quickly revisit the profit and risk profiles for the main strategies we discussed because they're quite different. Arbitrage.
Profits tend to be very small margins per trade. You need high volume and/or significant capital to make it worthwhile. The biggest risks are latency being too slow fees, eating your tiny edge, execution risk like slippage, API failures, and just fierce competition. The profile is potentially small, consistent gains if you can nail the execution perfectly.
Market making.
Profits come from capturing that bid-ask spread, multiplied by your trading volume. The main risk, as we said, is inventory risk holding assets that move against you. Also adverse selection, spread compression in quiet markets, and volatility risk. The profile is aiming for consistent, relatively small profits generated from volume.
And trend following.
Potential for substantial profits during strong, clear trends. That's the upside. But the major risks are getting whipsawed badly in choppy markets, overfitting your indicators, being caught by sudden reversals, and the lag inherent in indicators. It's often a profile of big wins during trends, but potentially long periods of stagnation or losses otherwise.
This really underscores why risk management is so vital, especially when the bot is making decisions on its own, potentially very quickly.
It's the bedrock. You absolutely must have safeguards. The core principles mentioned are things like stop-loss orders.
To automatically cut a losing trade at a certain point.
Take profit orders to lock in gains when a target is hit. Careful position sizing, risking only a small percentage, maybe 1–2%, of your total capital on any single trade. And portfolio diversification, spreading risk across different assets or maybe even different bot strategies.
The sources break down the types of risks, too. Technical risks first, like the tech failing.
Yeah, things like API delays or outages at the exchange, bugs in your bot's code. You mitigate these with robust error handling, timeouts, maybe redundant systems, prioritizing WebSockets for reliability. Rigorous testing, good logging, and keeping software updated are crucial.
Then market risks, the market itself doing something unexpected.
Right, sudden spikes in volatility, drying up of liquidity leading to high slippage, major news events, or those unpredictable black swan events.
How do you manage those?
Maybe by having the bot dynamically adjust its parameters based on volatility, or even pausing itself in extreme conditions. Sticking to liquid trading pairs helps minimize slippage. Using limit orders instead of market orders gives price control. Setting maximum daily loss limits or total drawdown limits. Some even pause bots around major economic news releases.
Security risks. We touched on API keys, but also spam bots.
Definitely. Hacked API keys are a disaster. Mitigation is strict security. Secure storage, IP whitelisting, minimum permissions, rotating keys periodically. And huge due diligence is needed before using any third-party bot or platform, especially avoiding anything that promises guaranteed profits. That's a massive red flag. Using well-maintained, ideally audited open-source software and secure coding practices helps too.
And finally, operational risks, like the strategy itself failing.
Yeah, things like over-optimization, which we discussed, or simply algorithmic competition. As soon as an edge is found, other bots swarm in to compete it away. And regulatory changes are an operational risk too.
Mitigation for those.
For over-optimization, Rigorous backtesting on diverse data, including data the bot hasn't seen before out of sample testing, realistic cost simulation, thorough paper trading. For competition, maybe focusing on longer-term strategies less vulnerable to HFTs or finding unique niches. And just staying informed about crypto regulations in your jurisdiction using compliant exchanges, keeping good records.
It's noted that even platforms like 3 Commas offer built-in risk settings, stop loss, take profit, position size limits that you can integrate. And AI for risk assessment is emerging too.
Ultimately, it bears repeating, effective risk management isn't optional. It's the foundation for surviving long enough to even have a chance at consistent profitability.
Okay, foundational building, bot types, the profit risk reality. Now let's get to the really cutting edge part. Our sources point to Bittensor as this potentially game-changing element, a decentralized AI marketplace offering a possible edge through, like, collective intelligence.
Yeah, Bittensor is described as this open source protocol aiming to create a peer-to-peer network, specifically for sharing and monetizing AI models and other forms of digital intelligence. The big idea is to build an incentivized marketplace for machine intelligence itself.
And it has different layers, a blockchain part and then networks doing the work.
That's the gist of it. There's the subtensor blockchain, which acts as the main ledger, handles identities, tracks ownership, and distributes the TAO token rewards. And then you have subnets. These are the off-chain peer-to-peer networks where the actual AI computation or other specialized work happens.
The TAO token seems pretty central.
It really is. TAO is used for accessing the AI services on the network, for staking, which is like supporting specific validators or subnets you believe in, for governance votes, and it's the incentive, the reward paid out to the miners doing the work and the validators checking it. It has a fixed supply, 21 million, and a halving schedule, similar to Bitcoin. It's designed to fuel this market for intelligence.
So subnets are like specialized divisions within this bigger Bittensor ecosystem.
That's a good way to think of it. They're the core operational units. Each subnet focuses on a specific task. Could be text generation, image creation, data scraping, scientific computation, or, relevant to us, financial prediction.
Okay.
Each subnet has its own incentive mechanism designed by its creator. Within a subnet, you have miners. They run the actual AI models or perform the defined task. You have validators. They evaluate the quality and usefulness of the work submitted by the miners. You can see the different active subnets on explorers like tao.app.
And there is something called dynamic TAO mentioned, a recent change.
Yeah, that's a pretty significant evolution. It introduced the idea of subnet-specific tokens, sometimes called alpha tokens, for most subnets. The goal seems to be decentralized valuation. The idea is the collective market perception of a subnet's value, reflected partly in its alpha token's activity or price, influences how much of the overall TAO emission that subnet receives.
And TAO holders can stake their TAO to specific subnets to earn these alpha tokens, kind of like betting on that subnet's success.
Exactly. It allows TAO holders to signal confidence in particular subnet's intelligence or utility, and earn rewards specific to that subnet. Subnet 0, the root subnet, still exists for general TAO staking that isn't tied to a specific task. It turns each specialized subnet into potentially its own mini AI economy.
This sounds like where the superbot opportunity comes in, particularly for finance, because Bittensor supports financial prediction subnets.
Right. A key example highlighted is the Taoshi subnet, the subnet 8, also called PTN or Proprietary Trading Network. Its whole purpose is to be a decentralized network generating and evaluating AI-driven quantitative trading signals, initially focused on Forex and crypto markets.
How does that work specifically? What do the miners on Taoshi do?
Miners on Taoshi develop and run their own trading models. They then submit signals, basically long, short, or flat predictions for various assets, along with a suggested leverage level.
And the validators check these signals.
Yes, but crucially, they don't just check for accuracy. The validators on Taoshi track virtual portfolios based on each miner's signals and evaluate them primarily on risk-adjusted returns.
Not just raw profit. What kind of metrics?
They use things like the omega ratio, Sharpe ratio, Kalmar ratio, Sortino ratio, and T-statistic. They heavily penalize miners for large drawdowns, significant dips in the virtual portfolio value. Taoshi has quite strict rules about this, and also about things like copying other miner signals. They even provide some training data and base models to help miners get started. And this data, like the signals from miners, is accessible programmatically via APIs.
Are there other subnets relevant for trading bots?
Definitely. There's the time series prediction subnet, TSPS. It focuses more purely on predicting future price points, like forecasting the next 105-minute closing prices for Bitcoin. Validators there score miners mainly on the accuracy of those predictions. You could potentially leverage SN1 Apex, the main LLM subnet, for sentiment analysis from news or social media. There might be general data provisioning subnets or other prediction-focused ones like SN55, which aims at 1-hour BTC predictions.
So if you want to build a super bot using Bittensor, what are the main ways to approach it? Two paths seem apparent.
I think that's right. Path 1 is to become a top-tier miner on a relevant subnet like Taoshi. This means developing a truly unique and high-performing predictive model. But importantly, it's not just about predicting price. It's about optimizing your model's outputs to score extremely well according to that specific subnet's incentive mechanism. For Taoshi, that means a relentless focus on generating signals that produce strong, risk-adjusted returns and tightly controlled drawdowns.
So you're building a model to win the subnet's game, basically.
Precisely. And Path 2. Path 2 is to be an intelligent consumer or synthesizer of the alpha generated by the network. This could be as a pure trader, or perhaps even as a validator. You build a bot that queries signals from one or multiple financial subnets. The super part here is developing sophisticated logic to filter these signals, maybe based on miner reputation, historical performance, or subnet consensus, validate them, potentially combine signals from different sources or subnets, maybe fuse this collective intelligence with your own proprietary data or analysis, and then use that refined signal to execute trades on regular external exchanges.
And being a validator gives you a front row seat to that intelligence.
Exactly. As a validator, you're actively evaluating the miner's outputs for the network, which means you get direct access to that potentially valuable validated intelligence stream, which you could then leverage for your own trading.
Okay, practically speaking, what does someone need to do to start building a bot that interacts with Bittensor?
First, the setup. You need to install the Bittensor Software Development Kit, SDK, and the command line tool, btcli, which is usually done via Python's package manager, pip.
Then my wallets.
Yes, you need to create Bittensor wallets. A cold key, which holds your TAO securely offline, and one or more hotkeys, which are used for the actual online operations, like registering and running your bot or neuron on a subnet. You manage these using btcli.
And you need TAO tokens.
Right. You typically acquire TAO from cryptocurrency exchanges where it's listed. There's also usually a testnet with free testnet TAO available, which is essential for development and testing without risking real funds.
How does the bot actually talk to the network?
Primarily through the Bittensor SDK in your Python code. You can use it to query the state of the network, like finding information about subnets and the miner's validators on them using functions like bt.metagraph. There's also a more general subnets API, and often subnet creators provide their own specific APIs for accessing their subnet's data, like the server providing Taoshi PTN signal outputs. Some third-party aggregator services, like Corcel, are also emerging to simplify data access.
So when designing the logic for that super bot, how does the Bittensor part fit in?
If you're building a consumer bot, your core logic focuses on integrating those Bittensor signals. Fetch raw signals from relevant subnets. Apply your filtering, validation, and synthesis rules. Maybe you weight signals from miners with higher historical scores on Taoshi, or combine predictions from TSPS with signals from PTN. Then the output of your logic becomes the trading signal fed into your existing order execution and risk management modules that connect to Binance, Kraken, or wherever you trade.
And if you're building a miner bot for, say, Taoshi,
It's a different challenge. First, you need to develop your unique predictive trading model. This might use traditional market data, but potentially also data from the Bittensor network itself. Then you need to implement the operational code for your miner neuron, often starting from a template provided by the subnet creator. The crucial part is ensuring the output of your model is formatted exactly as the subnet expects. A G, long short flat plus leverage for Taoshi. And, as we said, your internal model logic needs to be tuned not just for profit, but specifically to generate outputs that will maximize your score according to the subnet's evaluation metrics, the risk-adjusted returns for Taoshi.
understanding and optimizing for those specific subnet incentive rules sounds absolutely critical for a miner bot.
It's everything. Your rewards as a miner depend entirely on how the validators score your contribution. And the validators are incentivized by the protocol to score according to the defined rules to reach consensus. So your bot isn't just trading, it's competing to provide the most valuable intelligence as defined by that specific subnet's rules. Balancing profitability with risk control as defined by the subnet is key.
And you mentioned potentially being a validator, too.
Yes, that's another way to participate. It requires staking a significant amount of TAO, or the subnet's alpha token, running a reliable validator node 247, and contributing to the network's consensus by accurately evaluating miners based on the subnet rules. The super aspect for a validator, beyond earning rewards, is the potential to leverage that privileged view of the entire validated intelligence flow from all miners on the subnet for their own separate trading activities.
So the real super edge with Bittensor, it's not just about having a good standalone strategy anymore. It's about this deep integration.
I think that's the key takeaway. The differentiators for a truly advanced Bittensor integrated bot seem to be generating genuinely superior alpha that aligns perfectly with subnet scoring rules if you're mining, or applying very sophisticated filtering, synthesis, and execution logic if you're consuming signals.
Plus, being adaptable to how these subnets and their token incentives might change over time. Robustness, efficiency, security across both the Bittensor layer and the exchange layer. Making smart strategic choices about which subnets to engage with, how to stake, and yeah, still needing low latency for the final trade execution.
It definitely demands a broad skill set. You need the quant finance knowledge, the AI and machine learning chops, solid software engineering, and understanding of decentralized systems and token economics. It's really operating at the intersection of several complex fields. It feels like a frontier.
Wow, okay, what a journey. We've gone from the ground up, the structured steps for building any bot, the sheer variety of strategies they employ, through the really crucial, often sobering look at profitability and the absolute necessity of risk management.
Yeah, and then layering on this fascinating new dimension with Bittensor, exploring how decentralized AI networks could fundamentally change the game by creating these incentivized markets for financial intelligence.
So, key takeaways crystallizing for me. Building needs structure, a systematic approach. Python's ecosystem is a massive accelerator. Backtesting and paper trading is absolutely vital, but always remember, past performance is no guarantee.
And understanding that different strategies have vastly different risk-reward profiles. There's no one-size-fits-all bot. Market making is different from trend following, which is different from arbitrage.
And risk management, risk management, risk management. It's not just a feature, it's the foundation.
Yeah.
It dictates whether you even survive long enough to learn and potentially profit.
And Bittensor adds this whole other layer, this idea that you can tap into or contribute to a collective intelligence market specifically focused on finance, driven by these token incentives.
This whole deep dive, it really feels like it highlights this accelerating convergence, doesn't it? AI, decentralization, automated finance, all blending together.
What does that mean going forward? Well, it could spur the development of more specialized, maybe more transparent and robust financial AI models accessible via these networks. It creates new forms of competition, certainly, but maybe also new avenues for collaboration between different AI agents or strategies.
And it definitely seems to signal that future success in this space will demand increasingly diverse skills. It's not just coding, not just finance, not just AI, it's the combination. The trajectory seems to point towards more adaptive, maybe even more autonomous AI agents participating in markets.
And here's a final thought to chew on. With that dynamic TAO model and the subnet-specific alpha tokens, when you participate deeply in Bittensor, whether as a miner, validator, or even a strategic staker, are you just building or using a trading bot on a network? Or are you actually, in a way, strategically investing in and shaping the very decentralized AI models that might just become the core engines driving the next generation of automated trading?
What really stands out to you from all of this?